Hello. Emerging markets made many of the investment headlines in 2018 and not always for the right reasons. Will they be at the centre of things in 2019 as trade battles become wars, debt piles mount up and easy money from central banks dries up? Well, with me in Fidelity's Hong Kong studio are equity portfolio managers Hyomi Jie, who specialises in China and Taiwan, and Teera Chanpongsang, who covers wider Asia. Thank you both very much indeed for joining me. Now, Teera, let's start with you and Asia. 2018, good fundamentals, but it still ended up being a very tough year. Why is that?
Yeah. If we have looked back in 2018, start with 17 first. We came from the year that we have low expectation beginning of 17, therefore we have 42% return in Asia market as a whole.
An extraordinary return.
Extraordinary.
So difficult to
with
beat in any circumstance.
8 to 10% currency gain from that part. For 2018, we start with high expectation at the beginning of the year. You see strong market first 2 months. Yeah? And then begin with the concern that the US interest rate going up, US dollar very strong. For currency in Asia have been weak, and then you have the headline of Turkey, Argentina, and then come to the trade dispute between China and US that caused a lot of market concern. For we see equity outflow, especially from ASEAN country. For that is kind of the backdrop of the weak market performance in 2018, both from high expectation and both on the fundamental issue on the trade dispute.
So you've painted a broad picture there of some of the problems. We'll come back to a number of them over the next few minutes. But how do you expect 2019 to develop, looking at the region as a whole?
We have much lower expectation to begin with. The valuation of the market are much cheaper than beginning of 2018. But the volatility and uncertainty will continue to be there.
Okay, well let's move from the individual stocks and still to the country's, the region's largest economy. Hyomi, everywhere seems to take its lead in Asia from China. How do you expect the trade war with the US to continue in 2019, and what impact will it have?
I think trade war between US and China is going to be a more normal and longer term reality to both countries and also to the wider economy globally, I think. I think the impact to the region as a whole will be pretty significant in a way. First of all, if you think about some of the key sectors that China has been the export to the global market, let's say tech, then it supports the whole global supply chain while you have manufacturing bases in China. They import components from other regional markets, including Korea, Taiwan, and when the manufacturing base can ultimately diversify from mainly focused in China towards ASEAN countries or other Taiwan countries, how the supply chain will all move together, that remains big uncertainty. So I think the impact will not just be limited to China, but to the wider region.
And looking at sectors in particular, it's not just going to be the export as you explained, but how might that spread out to other sectors as well?
One obvious area, I think, would be general consumption sectors. Now, I think it's more of the sentiment driven, because frankly speaking, there has been a lot of talks about how things will evolve in terms of this China-US trade war, but nothing has really happened yet until the first tariff was levied in late September. So we are only going to see that impact from here on.
So we haven't seen anything yet. And which are the sentiment-driven sectors that you're thinking of?
I think consumption in general, especially more on the discretionary spending, is highly related towards confidence. So when the consumers have confidence about their future income growth and also employment robustness, they are more willing to spend on discretionary items. But when things are uncertain, you don't know whether things will slow down or it can actually be stable. You don't know, but you want to wait and see.
Now, Teera, in the past, when there have been shocks to the Chinese economy, the government has been able to take stimulus measures to try and turn things around, and that's actually been to the benefit not just of China but the region region and indeed the world. Have they got the capacity to do that again?
There's a lot of discussion among the Chinese government, but nothing really implemented yet. That's more of the discussion. But I think it's more towards the particular sector. If I look at the trade dispute, if the tariff come to full impact, I would expect that the Chinese government will have, like in the old day of value-added tax refund for the exporter to help reduce their operating costs.
Would that be enough, Hyomi? Would that change how you feel about things? Are you still worried, or do you think that this sort of intervention would help?
No, I think I agree with Teera that this sort of intervention or stimulus will definitely help to restore consumer confidence. But the thing is, people will believe when they really see the results coming in.
Let's talk about something else which often feels intangible, which is debt in China, which has just grown and grown in recent years. It's now 3 times GDP. Is that sustainable?
I think that there are 2 ways to think about that. Where is this debt going into? One big area, and which has been regarded as the traditional place where this debt goes to, was mostly fixed asset investments and also property markets. That I think largely is driven by the government's policy. If they believe that the debt can continue to stimulate fixed asset investment and property investment, which is a big part of GDP, I think with the blessing of government, that debt can continue to increase at a manageable rate. The other part is consumer debt, which has been largely ignored until 2010, 2011. So you can see that the absolute level of non-mortgage debt in the consumption space in China is lower than US, but the speed of the debt expansion has been very, very rapid.
And that could be destabilizing in itself, couldn't it?
Exactly. So I think, in my view, that's one risk area that we all need to watch out very carefully, because the expansion of consumer debt has been very, very fast over the past 5-7 years.
Do you agree, Teera? Does this spread throughout the region?
One good thing when I compare with the Asian financial crisis in 1997, the Chinese debt is more towards domestic debt. Into 1997 in Asian country, we have huge foreign capital inflow come to the country. When the currency depreciates, you have huge outflow. That's why Asian financial crisis happened in Asian country.
Okay, so you already touched at the beginning on some of the destabilization we've seen in places like Turkey as the US cycle changes and the impact that it has many, many thousands of miles away in places like Turkey. How are things going to develop in 2019 as the US continues its tightening cycle? As you say, the foreign inflows of debt are not quite the same that they were. Is it going to be contained, or should we be reassessing the risk in emerging markets?
I do the comparison when I look at 1992 to 1997, 5 years before Asian financial crisis. You see the pace of Thailand, Malaysia, Indonesia, Philippines. We have huge current account deficit between 5 to 10%. This is what is the backdrop that happened to Turkey and Argentina with huge current account deficit. But when you look at foreign debt to GDP of all the Asian or Asia economy, we have very low compared with the past, 50% lower than the past. And current account deficit, many countries in positive. Therefore, we have to look at the country by country and look at the trend. And then the one difference between Asian financial crisis and today, if you look at corporate, in the old day, the corporate have 200% net gearing is acceptable. Today, you don't have any company more than 100% or even 50% because corporate got burned out 20 years ago. They learned the experience. And second, if you talk about the corporate in Asia, almost 80% is domestic debt.
So it should offer an element of stability in the coming year. Well, that's a good note to end on. Teera and Hyomi, thank you both very much indeed. And thank you for watching. We've got plenty more on Fidelity's outlook for 2019 on our websites. But it's goodbye for now from all of us here in Hong Kong.